Hello everyone, welcome back to the US individual taxation class of the Enroll Agent program. In this class, we'll be discussing in detail about how to use prior year tax returns for filing the current year tax returns and identification of the residential status of the individual. So whether the people are resident or a non-resident alien. So let's understand more in detail. Hi everyone, welcome to the US taxation class chapter 2. In the chapter 2, if you see what all things we have covered and what all we are planning to cover in today's and tomorrow class to finish off chapter 2, which is income and assets. So far, we have covered type of income, which include like all category of income. Then we discuss on installment sale, cryptocurrency, non-business bad debts, pass-through entity, right? These all we have covered till last class. So in today's class, we'll be starting with the retirement income, including individual retirement account and retirement contribution limits and deductible, in which we'll be understanding traditional IRA, Roth IRA, within the traditional deductible IRA and non-deductible traditional IRA, right? And then we'll be understanding about rollover and conversion process from one IRA to another IRA, and then minimum required distribution at after specific age, which is being required from this IRA, which is like individual retirement account. So this all we'll try to cover and finish off today. And tomorrow we'll be targeting to finish off like assets, category of gain and loss, assets basis, holding period, basis of stocks, after the stock dividend and stock split. And then lastly would be adjustment to income. So this adjustment to income, some of it we already have covered, like when we in the chapter 1. So it's kind of, like reiterating few stuff and some new additional adjustment for this will be understanding in this chapter, right? So now let's jump into the main topic. Hope you guys have revised the notes. Did you guys get a chance to look at the notes by any chance? Mayank, Vikas, Divya, Shubham, Garima, Rajat Mathur. Yes, have you got a chance to go through the notes? Not really? Say yes or no.
Not really, sir.
Okay. How about others? Mayank, Shubham?
Yes, sir.
Gone through the notes?
Yes, sir.
Okay. How about you, Mayank?
Sir, I got
Rajat?
from the class, sir. Like,
say that again.
I basically I don't go into notes. I revise the whole class. I just go on the class and play it on 1.75x and like revisit it again. So I do that.
Okay. Okay.
All the classes which I am not able to get, only for those classes I do.
Okay. Rajat, how about you?
No, sir, didn't get a chance.
Didn't get a chance. Why? Any specific reason? Small notes, few pages only. Not much. But yeah, please go through the notes. Otherwise, we are moving along with the new stuff, but we start losing out the understanding about like stuff which we have studied, because like after this weekend we'll be almost done with 2 chapters, which is like almost 40% of your exam, right? So do the revision simultaneously and must do the practice also simultaneously. Otherwise, it will be difficult for you guys only to crack the code. Like in exam time, you may struggle then. Good. Okay. So yeah, today we are starting with the retirement income, including individual retirement account and retirement contribution limits and deductibility. In this, two major things. One is traditional IRA, and the another one is Roth IRA. Sorry, my bad. Another one is Roth IRA. So in a traditional IRA, there are two sub category of IRA. One is deductible traditional IRA, another is non-deductible traditional IRA, and then Roth IRA is like new age IRA program basically, right? If I high level give you overview of what is deductible IRA, is basically when you make a contribution to the individual retirement account, then in the year of the contribution, it is considered in the itemized deduction. Hence, it is called deductible IRA. That means in current year gross income, certain amount or up to certain limit, the amount which you have invested or deposited into the individual retirement account is being considered as itemized deduction, and you will get tax benefit on it. Right? Non-deductible traditional IRA means when you contribute to the IRA, but it is not considered into the itemized deduction. That means it is taxable. The amount you have contributed is already being taxed as a gross income to you, right? So this is the major difference between traditional deductible IRA and traditional non-deductible IRA. But good thing and bad thing is that when you have deductible traditional IRA, that means in the current year, when you have made a contribution, like in India also, for example, if you make a contribution to the PF or PPM, so it is being considered into your deductions of under Section 80C in India, right? Same way in US, when you make a contribution in the IRA, which is a deductible contribution, at that point of time, you can reduce up to certain limit. We'll be understanding what are those limits, amount from the gross income, right, which is adjusted gross income as an itemized deduction, and you'll get the tax benefit in the year of contribution, right? So in the year of contribution, you are getting the tax benefit, but in future, when you withdraw the amount from the IRA, then principal and the interest or dividend, whatever you have earned on those deductible IRA, is being taxed in the year of withdrawal. That means traditional deductible IRA, it helps you saving certain taxes today, but you need to make the payment of the taxes in future. So if you are doing like tax planning for your clients, so you need to understand the tax status, or the year over year income growth or change in the income, whether your client is being expected to earn more in current years and less in future years. That means after the retirement, he may not have that much source of income. Then in that case of scenario, deductible traditional IRA is good one, right? For example, let's assume your client is a salaried employee, right? When your client is a salaried employee, he or she is earning in the years when he or she is working. But after the retirement, he or she may not have that much income. He or she may have some pension income, some social security income, or maybe some rental income, some interest income, some dividend income based on like saving or investment that an individual has made, but not that great as what he or she is earning in the salary today, right? So in that case of scenario, traditional IRA is good. Why it is good? It will reduce the tax burden in current year when the individual is earning good, and in future year when he or she will come in the less tax bracket. At that point of time, when he or she withdraw, then that amount will be taxable along with the interest, right? Make sense? Make sense? Or
Yes, sir.
shall I explain with some example?
Sir,
Raja?
example.
Okay. So, okay, let me open an Excel sheet. So this is about Traditional IRA. So let's say now, let's assume Mayank, and this is financial year 2022. '23, 24, 25. Let's assume 26. 30. So let's assume Mayank is expected to retire in 2029. And he has salary income, rental income, interest income, and what other income? Dividend. Let's assume Mayank has these all incomes. Let's assume he has $100,000 and he is working in a good company. So every year he get 10% increment, let's assume. Right? And in 2029, he is getting retired. So his income for 29 and 30, let's assume is no salary income. Right? And rental income, let's assume Mayank has a property which he earned $10,000 a year rent, and that also increase at the rate of 1.05% every year. So this is the rental income that Mayank do earn. Right? And then interest income, let's assume he earned $2,000 interest year over year, and he earned, let's say, $3,000 dividend year over year. So now Mayank has earning Mayank has gross income this year over year. And now Mayank do contribution in traditional IRA of, let's say, $6,000 every year. So taxable income for Mayank will be how much? Right? This is taxable income. So this is your deductible, traditional IRA deductible. So while you're earning, so you choose deductible IRA, and now let's assume retire at 60 age, right? At this age, you got retired and you withdraw. And interest. Let's assume you withdraw 21,000 in this year and this year. So your taxable income will be this much, right? And if tax rate while you are working, let's assume 20% bracket you were in, and after retirement, let's assume you got 10% bracket. So your tax here is this multiplied by 0.2. This is your taxable income, but now your total income is less, right? So you are in lower brackets, your tax is this. So now if you see, you have paid $4,007 only as a taxes in the year of retirement, and following year 4,077, compared to how much big tax you are paying here, right? And if you compare, like if this 21,000 is coming out of it, so earlier you were paying 20% tax, but now you are on a 10% tax slab. So if assume like 20% or 10%, so you are saving 2,100 rupees on taxes. Make sense, Mayank?
Yes, yes.
Hmm?
Yes, I got it.
Everyone? Yeah, Vikas, Vivek, Sachin, Rajat, Divya. Sort good? Eh?
Yes,
Yes,
sir.
sir.
Yes.
Okay. So let's keep. Now let's assume it was. Keep the same example in mind. And let's keep the same example in mind. And if this is non-deductible, if it was non-deductible, then there was nothing. It will be 0. So no itemized deduction, right? As it was non-deductible, so this withdrawal is also being non-taxable. Got it? Because you have paid, if you see, you have paid more taxes. This minus this, because you have already paid more taxes in the year. Hence, when you withdraw, your taxes will be less comparatively. Does that make sense? When it is non-deductible. So earlier it was deductible. So we are reducing in the year you are earning and contributing. But another type of IRA is non-deductible IRA. Non-deductible IRA means the year in which you make the contribution, you will not consider that as itemized deduction. So if you are not considering that as itemized deduction, that means you are paying taxes. Make sense?
Yes, sir.
So if you are not deducting as itemized deduction, that means you are paying more taxes as you are already paid the taxes. So in future, when you do the withdrawal, it is tax-free. Make sense? As you have already paid taxes in earlier years. Yes, no? Garima? Vikas?
Yes.
Okay, cool. And now coming to the Roth IRA. Roth IRA is always a non-deductible. Roth IRA is always a non-deductible IRA. That means as in when you make the contribution, you'll be paying taxes. That means every year you are paying taxes. But the withdrawal is exempt and the interest and dividend which you have earned is also being exempt in case of Roth IRA. Right? So Roth IRA goes similar to traditional non-deductible IRA. So Roth IRAs always be a non-deductible. Make sense? Divya, Vikas,
Yes, sir.
Rajat, all good? Okay. So in addition, so this is like high level concept. We'll be going into more detail one by one, but just high level giving you overview what is traditional IRA, and within the traditional IRA, what is deductible, what is non-deductible, and what is Roth IRA. So these are three main concepts which definitely you'll be getting in your exam. So out of this topic, you will be definitely getting good number of questions in your exam for sure. So this is like kind of very, very important topic. In this topic, we'll be understanding rollover or conversion. Rollover and conversion means when you are converting from traditional IRA to Roth IRA, traditional deductible to traditional non-deductible, or traditional non-deductible to traditional deductible, or traditional non-deductible to Roth IRA. So any conversion, so any permutation or combination you are doing and you are changing your IRA status, then how to deal with it. What is being taxable and when it is being taxable and how much it is being taxable. That will be understanding. And then lastly, we'll be understanding the minimum required distribution. So after the age of 59.5 years of the individual who is making the contribution, there are certain mandatory distribution required. That will be understanding in the very last topic. Right? Got it, everyone? So what all 5 things we'll be covering? Traditional IRA, deductible, non-deductible, Roth IRA, rollover and conversion, and the last one is minimum required distribution of IRA. These are the 5 concepts we'll be learning in this topic. So let's understand more about traditional IRA and Roth IRA. So what is the maximum contribution allowed? Maximum contribution is whether you are doing Roth IRA or traditional IRA, maximum contribution is $6,000 combined annual maximum contribution with additional 1,000 catch-up contribution for age 50 plus. So if your age is less than 50, then you can make a maximum contribution of $6,000. But if your age more than 50, then you can make a maximum contribution up to $7,000. Make sense? Yes? No?
Yes.
Yes.
So this above the line deduction for contribution, these all are above the line deduction. That means these are being reduced as an itemized deduction from the adjusted gross income, right? So deductible is yes, considered as itemized deduction, but non-deductible or Roth IRA are not deduction, right? That is what we understood here. So deductible IRA, traditional IRA, that is being reduced, that helps in reducing the taxable income in current year, whereas Roth IRA or non-deductible IRA will not reduce the income. That means you need to pay more taxes if you are choosing non-deductible or Roth IRA. That is what it mentioned over here. For deductible, it is yes, but for non-deductible and for Roth, it is no, right? Another thing is withdrawal of contribution. When you make a withdrawal of the contribution, so whether it's being taxable or not, if it is taxable, then at what rate? So traditional IRA, first one is deductible. So deductible is taxable on withdrawal. Why it is being taxable on withdrawal? Because when you have made the contribution, you have paid less taxes, right? So when you are withdrawing, you need to pay tax on that. Whereas for Roth IRA or for non-deductible IRA, you will not get any deduction at the time of contribution. Hence, the withdrawal is non-taxable. Make sense? Third point, make sense, everyone?
Yes, sir.
So last point is withdrawal of earning. One is withdrawal of principal, but second important thing is you are also earning. When you make a contribution, like in India, when you make a contribution to PF or to any PPF or any other retirement plan, you get some earnings of interest, right? Same way in US, when you invest in IRA, you'll also get some interest income on that amount which you have contributed. Right? So that amount, in case of deductible, it's taxable. In case of non-deductible also, it is taxable. But good thing for the Roth IRA is that your earnings are also non-taxable, that is exempt from income taxes, right? If qualified distribution is taxable or if no qualified distribution, right? If you have not made any, that we'll discuss in detail separately. If you have made, if you have withdrawn before certain times or you have withdrawn unqualified, then it is taxable. But if it is from qualified Roth IRA, then it is not taxable. So key thing to notice, if you see this summary, key thing to notice is for deductible IRA, you will get tax benefit in current year, but in future year, you need to pay taxes on the principal and interest both. For non-deductible traditional IRA, you are paying taxes in current year. You will not get any benefit in tax on the principal which you are contributing today, and the same principal which you are withdrawing in future years is also not taxable. But point to note over here is any interest which you have earning on those contribution year over year to non-deductible is being taxable in the year when you withdraw from it. Whereas for Roth IRA, your contribution is non-deductible. That means in the year you are making contribution, it is not considered into itemized deduction. You need to pay more taxes. But in future, when you withdraw, both your principal as well as interest which you have earned, they both are exempt. So that is the benefit of Roth IRA over the traditional IRA. Make sense? Any doubt, guys, so far?
Yes, clear.
Yeah. Mayank, Garima, Divya, Rajat, all good? Okay, so now let's understand what is the annual maximum contribution to IRA. What is the limit? So IRA contribution is limited to lesser of, or under the age 50, there is a separate limit. 50 to 70 and a half is separate limit, and more than 70 and a half, they require no limit. You can contribute if you want, right? So first one is for unmarried. Unmarried people can contribute up to $6,000 of the earned income. $6,000 or the earned income, whichever is more, right? And the age bracket group of 50 years to 70 and a half, they can contribute $7,000 or the earned income, whichever is less, right? So for less than 50-year age, maximum contribution can go $6,000. For 50 to 70 and a half year age, maximum contribution can be made up to $7,000. That is $1,000, which you have studied above, is the additional contribution that people can make, right? And the people who are more than 70 and a half, they are not required to make any contribution, right? Next is married people. So married people mean married who are filing jointly. If they are filing individually, they will be considered as single. But if the married people, they are filing jointly, then they can contribute up to $12,000. That is $6,000 each, or the earned income of married couple. If the age of the couple, both of them, is more than 50, then they can contribute up to $14,000. For example, one couple is 51-year age and the another one is 49-year age. So 6,000 for the 49 and 7,000 for the 51. So total contribution maximum they can make up to $13,000. If they both are more than 50, then they can make up to the $14,000 contribution, or the earned income of the couple, whichever is lower, right? So this is like maximum contribution limit. Do you know in India also there is a maximum contribution limit to PF? Do you know what is that amount? Any of you have idea how much maximum contribution you can make to PF? Yes, no? Guys, are you here?
10% of the basic. 10% of basic.
No. Vikas sir? Sachin ji? Any idea? What is the maximum contribution you can make to PF? 70,000 rupees in a year. Maximum contribution which you can make. Right? Same way in US also, the maximum contribution limit is $6,000 and more than 50-year age, 1,000 additional. But more than 70 and a half, then no, zero. Right? Now, here the question, in the question if you see, or in the context if you see, it is mentioned $6,000 or earned income, whichever is lower. So now let's understand what is earned income to be considered here. Earned income majorly include active income, not passive income. If I simplify very easily. So if you see what is being included in the earned income is your salary, your wages, your commission, your bonuses, your alumni degree, if it is, if you got the degree before December 2018, right? If you received the alumni for the court order or degree on or after December 2018, then it is not included. So net earning from self-employment. If you are a sole proprietor, then net earning from your proprietorship.
What about child support?
Child support is never be an income.
Okay.
Child support neither an income nor an expense. It's all personal. Right?
Yep.
So this is considered in the definition of the earned income for the contribution purpose. Right? So your income from interest, dividend, annuity income, pension income would not be part of earned income, which you need to consider for the contribution purpose. Right? And any alumni received on the core degree on or after December 2018, that is also will not consider. Right? Any doubt so far? Mayank, Garima, Vikas, Vivek, Sachin.
Sir, sir, it was in unmarried status. It was noted that if they are filing jointly, then it will be considered only, not the individual one, not the separate one.
No, if they are filing separately, then the above limit will be follow 6,000 and 7,000. If they are filing jointly, then 12,000 or 14,000.
I was not able to get the 6,000 numbers.
This one.
Yes, sir. The 6,000 for the each, if they are filing separately.
Yes. Got it.
Yes, sir.
So now let's understand more in detail about deductible traditional IRA. So the traditional IRA is deductible from the gross income to arrive the adjusted gross income. So if you remember the notes of very first class, not this one. Second. If you remember in this very first class where we discuss about this, do you remember? Like this should be, like always be a guiding reference for you. So here, if you see, like how do we calculate the tax waiver of the individual or, like for any sole proprietor or company. So first, generally, we consider gross income. which we understood in chapter 1. We understood deduction from gross income, right? Then we calculated adjusted gross income. Then we understood about standard deduction, itemized deduction, right? Here, if you see what it's saying, the traditional IRA is deductible from gross income to arrive at adjusted gross income. So here in this, it comes as a tax as a deductible from the gross income to arrive at adjusted gross income. The adjustment is allowed only if the contribution is made by the due date. This is also very important. If you are making a contribution after the due date of tax return, then it will be allowable in following year, not in current year, right? For what is your tax year generally for individual? January to
December.
January to December, right? And what is the due date of filing is for individual?
15th April.
April 15th of the following year. So what they are saying, the contribution you need to deposit on or before the due date to consider that as an itemized deduction. That means for, let's assume your tax year is financial year 2022, which is January 2022 to December 2022, right? And you want to file your tax return on or before April 15, 2023, right? So what the law is saying, like you need to deposit the IRA on or before 15th April 2023, right? Make sense? For the period January 22 to December 22, you can deposit even after that, but on or before April 15 next year.
So what about filing extension, and if we don't owe IRS some penalty or taxes?
Say that again.
So what about if we file an extension before the due date, and if we don't owe the IRS any taxes or the penalty?
So very good point, Shubham here. Two things. One is, like this deduction, this itemized deduction will be available only if you have deposited this to the IRA on or before the due date. So if you have deposited, then it is okay. You can claim the deduction. And if there is no tax due to the IRS, then you can also file the extension. So there's no problem. But on the other hand, if you are planning to file the deduction and you have not deposited to the traditional IRA, then in that case of scenario, you cannot consider this amount as a deductible and you need to pay more taxes on or before the due date to get the extension. And the amount, for example, instead of 15th April, you have deposited in, let's say, May next month. Then that deposit would be considered for the next year, not for this year. So you can take the benefit in the following year, not in current year. Make sense?
Yes, sir.
Mayank, Garima, Vivek. So far, so good?
Yes, sir.
Yes, sir.
So the traditional IRA is deductible from gross income to arrive at the adjusted gross income, and the adjustment is allowed only. Adjustment is allowed only if the contribution is made by due date. Features of deductible traditional IRA. What are the features of deductible traditional IRA? First is earning accumulate tax-free. That means your earnings of the current year have less tax liabilities, right? Second is distribution from traditional deductible IRA are taxable as ordinary income. So in future, when you are getting this amount, which we have discussed in our example, in future, when you are withdrawing from the IRA, so this 21,000, this is being taxable at the ordinary tax rate, not a capital gain or not a gambling income, which is very high rate, right? Or not any other category of specific tax rate, right? It is considered as the ordinary income. and it is being taxed at the routine tax rate, which is generally, in this case, like the example which we have discussed, is the lower slab. Right? So next thing is distribution from traditional deductible IRA is taxable as ordinary income and may be subject to applicable 10% penalty if withdraw before the age of 59 and a half year. Right? Unless there is an exception. So there are certain exceptions, we'll be discussing that. But principal rule is that if you are withdrawing deductible traditional IRA on or before the age of 59 and a half, then in that case of scenario, there is some penalty, which is like 10% of the amount which you have withdrawn. But there are certain exceptions to the general rule. So the withdrawal can be made for medical emergency or maybe for all specific reason which has been mentioned. We'll be discussing in detail one by one. But those unforeseen reason for which, for your survival or for any medical benefit or for any such reason, if you're required to withdraw even before 59 and a half years, then you can withdraw, but you need to give the declaration and the proof why you have withdrawn and how that is being satisfied the requirement of those exclusions. Right? Note here is, since only once in 12-month period a taxpayer can make a distribution to himself and herself or transfer from one traditional IRA to another traditional IRA without interest or penalty for a maximum of 60 days. So in a period of 12 months, maximum you can withdraw for a period of 60 days. You cannot withdraw for more than 60 days the amount which you have contributed to the IRA without interest or penalty. So there is a flexibility they have given to you. If you wanted to withdraw from the IRA without impacting the penalty provision, then you can withdraw at the maximum for the 2-month period in a period of 12 months. But you cannot continuously start withdrawing every 2 months or leaving a few days and withdrawing again for 2 months. So this is not your check-in account, right? This is your kind of saving account where you need to hold the money so that it will generate certain sustainable income for you in future when you get retired. Right? That is the objective and intent of the lawmaker. Make sense? Third point is minimum distribution is required to be taken by April 1st of the year following the year in which the taxpayer reaches the age 70 and a half year. So when taxpayer reaches the age of 70 and a half year, then there is certain minimum distribution is being required. So that is, you can say forced distribution or mandatory distribution, or you can say they request the individual to withdraw. Right? At what age? 70 and a half. So once the individual cross 70 and a half at any point of time on or after the April of that current year, 1st April of the current year, then that individual need to do the withdrawal of minimum amount. So what is that minimum amount? We'll be discussing in detail that also. But just keep in mind, the individual need to withdraw from the traditional IRA once he or she reach the age of 70 and a half years. And limitation of deduction of traditional IRA contribution. So there are 2 limitations. A point is, if the taxpayer participate in the employer sponsored retirement plan. So if you are a taxpayer and you are already being enrolled in the employer sponsored retirement plan, whether it's defined benefit plan or it's a contribution plan or it's maybe any other benefit plan for the long term, then the following AGI limits applies to the deduction allowed for the contribution made to the traditional IRA. So what is the maximum contribution you can make? So there are phase out limit. Do you know what is phase out limit? Have we discussed this? Do you remember in the very first class, we discussed about phase out limits, Robin Hood rules, if you guys remember? Yes, no? कुछ तो बोल दो. Are you guys not at all revising? In the very first class, we discussed phase out rule.
Yes, sir. वो Robin Hood वाला हमने किया था. Yes, sir. I remember.
What is that?
Sir, giving away से कुछ था concern.
So phase out meaning like so like जैसे जैसे आप rich होंगे तो like you are given less tax break, something like that.
Yeah. Mayank, you also shared something that day about the Robin Hood rule.
So I remember like giving like giving the benefit of like something I remember.
Yeah, Vivek, Sachin. No idea?
Taking away from the richer and giving to the poor.
Yeah, absolutely right. Taking away from the richer and giving it to the poor. So that means phase out will be as and when you start earning more and more, you will be getting eligible for less and less itemized deduction. If your income is less, you'll get more tax benefit. But as you start earning more, the tax benefit will start getting reduced. That is called Robin Hood rule, or you can say phase out process, right? So in case of your filing status unmarried or head of the household, the phase out is $66,000 to $76,000. That means how much is the contribution an individual can make? Do you guys remember how much a contribution an individual can make? $6,000?
Yes, sir.
Right? So contribution, you can make $6,000, right? So how much is the deduction allowed? If your income is, let's say, $65,000, $75,000, or $100,000. So your income is, let's say, this. See, this is your income, right? Now your individual, or you can say single, or your married filing jointly. In case of married filing jointly, 21,000, let's say 200,000. Let's assume this. So now, in this case, when your earning is 66,000 or less, right? Then you'll be getting how much deduction?
6,000.
6,000 full.
Yes.
Right? Now, if your earning is 66,000 to 76,000, it will phase out. So it will phase out in 10,000, right? So here your income is $75,000, right? Let's assume $70,000. Sorry, Let's make a small change here. Here also 1,400. So now your income is $70,000 and the phase out limit is 10,000, right? Which is equal to $4,000 divided by $10,000 multiply by how much? 6,000. So how much is the phase out? 2,400 out of 6,000 minus this. So have you got it? Like how we get to 3,600? So your total contribution is how much? 6,000. Can you see the formula? Is formula visible to everyone?
Yes, sir.
So your contribution is how much? $6,000. Yes, no?
Yes, sir.
Right? And how much your income is more than the minimum limit, which is 66,000, $4,000, right? How we get this 4,000? How we get this 4,000? 70,000 minus 66,000, right? Your income is how much? 70,000 and the limit start from 66,000. That means your income is 4,000 more than the limit. Yes, no,
Yes, sir.
right? And what is the total phase out limit? $10,000, which is 66,000 and 76,000, right? This entire phase out limit is $10,000. And how much will be phase out? Multiply by 6,000. So 2,400 is a phase out. So how much is being allowable? 6,000 minus 2,400. Make sense?
Yes, sir.
Mayank, Rajat?
Yes, sir. Sir, you have written 4,000 and you have said that it is it just crossed the break-even point. So, what was the minimum amount for the 4,000 you have written?
No, 4,000 is 70,000 minus 66,000. So my earning is 70,000
Yeah.
and phase out limit start from 66,000.
Then, okay, sir.
Can you just give me a second? I have one start. Yeah, sorry, got some urgent call. Yeah, so Mayank, you got it, like how we get this 4,000?
Yes, sir.
And how we get this 10,000? 76,000 minus 66,000. So 10,000 is the total phase out limit.
Yes.
Right? So the proportionate of 6,000 we need to reduce. So 2,400 we need to reduce from the 6,000. Hence we get this amount of 3,600. Right? Right.
Is 400.
So now the total income is 100,000. That means more than 7,600. So there will no zero deduction allowed because it is more than 76,000, right? Now coming to another scenario, which is married filing jointly. So married filing jointly limit is 105 to 125,000. What is the limit? 105 to 125,000. So here it should be 105 to 125. Let's say 110,000. Or you can say 80,000, 115,000. Right. So here, if total income is 80,000, which is less than 105, so entire amount of 12,000 is allowed. Right. Here the income is 115,000 and the phase out at 105 to 125. That means 10,000 more, right? 10,000 more than the basic limit. Same formula we will apply here also. If you see, the total is 6,000, right? And 10,000 is more, and the phase out limit is 20,000.
6,000.
6,000. So 3,000 is allowed. Here it will be 0. Make sense? Have you got it? How we calculated this one? If less than the phase out limit, 100% is allowed. If more than the phase out limit, nothing is allowed. When it is in between the phase out limit, we need to do this math.
Sir, I think ये जो है ये $6,000 नहीं होना चाहिए सर, because जैसे सर हमारा AGI fees है वो 105 से 125 तक है, तो it means जो हमारी phase out limit है that is $20,000 limit है.
So that is the reason 10,000 divided by 20,000 I did.
नहीं सर, अगर जो हम ये बिना फॉर्मूला का डायरेक्टली माइंड में करें कि हमें जैसे 20,000,
you can mind में तो you can do anything.
नहीं सर, जैसे $20,000 की लिमिट है और $12,000 की डिडक्शन है, तो हम ये डायरेक्टली हम अप्लाई करें, क्योंकि जैसे कि 105 से 115 का डिफरेंस कितना 10,000 का है, तो और हमारी फेज आउट लिमिट 20,000 की है, तो सर ये 6,000 ही आना चाहिए जो आपने जैसे ये $3,000 आया.
1 second.
आई थिंक सर ये 6,000 आना चाहिए.
1 second. Just 1 second. An urgent message. I just need to give to. So sorry, say that again, Shubham.
जैसे हमारा जो AGI का फेज आउट लिमिट है वो 20,000 है टोटल.
ठीक है.
ठीक है सर, AGI का फेज हमारा 105 से स्टार्ट होता है और इनकम है 115 है. इसका मतलब 5 से हम 115 पे आए हैं. इट मींस $10,000 का जंप हुआ है हमारा.
Yes, this is what it is.
$10,000 को सर हम $10,000 20,000 का कितना हुआ? इट मींस 50% हुआ ना सर. 50% 12,000 का कितना होता है सर? 6,000.
Sorry, I think यहाँ पे here I need to take 12,000. Sorry, here I need to take 12,000. Yes, you're right. Yeah, you're right. So here we need to take 12,000 because it is married filing jointly. Right? Everyone got it? Vikas, Vivek, Mayank, Rajat.
Yes, sir.
Yes,
Got
sir.
it? So this is how you need to do the math, and you will see a lot of question in your multiple choice question coming from this kind of phase out limits. Taxpayer with AGI above the phase out range may still contribute up to 6,000 or 7,000 as the case may be. However, the contribution will not be deductibles to earning. will not be deductible from the earnings of such contribution and will be taxed. Right? So taxpayer, if the AGI is more than the limit, then also they can do the contribution. No one is stopping them to contribute to the IRA, right? But they will not get the benefit of deduction if it is more than the phase out limit. Second is, if taxpayer does not participate in the employer sponsored retirement plan, then following AGI limitation apply to the deduction allowed. So first one, which we have discussed, when you are already availing the benefit of employer sponsored program, then the phase out limit is less, right? When your employer do not have any sponsor program, or you are not working in any company, but you are making self contribution from your self-employment or from your partnership or from your sole proprietorship, in that case of scenario, the limit is more, right? For the married filing jointly, it is 198,000 to 208,000. For married filing separately, it's very less, 10,000 only. And for unmarried, there's no limit. So full deduction is available up to the contribution limit of 6,000 or 7,000. Right? Same rules apply, same calculation, same formula will apply. Make sense? Or you want me to do some math again? Shall I do the math again, or is it good?
It's fine, sir.
Fine. So this is about deductible IRA. So traditional deductible IRA, we understood the three things. What is deductible traditional IRA? What are the key features, right? What are the penalties applicable? What are the age limits applicable? And what is the phase out limit if you already being registered with the employer sponsor program? And what are the phase limit if you are not registered with any employer sponsor program, right? Now coming on to the new topic, which is non-deductible IRA. Non-deductible IRA, if taxpayer deduction for a contribution to traditional IRA is limited, a non-deductible traditional IRA contribution can be made. So for example, if you cannot contribute to the deductible IRA, then you can contribute to the non-deductible IRA, right? There is no limit to it. Second is, the overall limitation still applies to combined deductible and non-deductible contribution of 6,000, 12,000 or 7,000 or 14,000 as the case may be on the earned income, whichever is lower. So what does it mean? Let's assume you fall into this category, 7,000 category, or maybe in this category. So maximum contribution you will be making will be only that amount which is deductible, right? Why do you make the contribution in the deductible IRA when it is actually non-deductible? So here in this case, 3,600, you can make a contribution to deductible IRA, and balance 2,400 you can make to the non-deductible. What is the benefit? So there are difference in the interest rate. So it's being more viable to deposit in the non-deductible. And the another thing is Roth IRA. So where the earnings of this additional deposit is also tax-free. So in that case of scenario, you should contribute the remaining balance into the other. So maximum contribution limit is same, but you can split between deductible and non-deductible based on the limit of deductible comes out of you based on your earnings. Make sense? Yeah, Rajat, Mayank, Vikas.
Yes, sir.
So now the overall earning on non-deductible IRA contribution will accumulate as a tax-free until it is withdrawal. So at the time of withdrawal, the principal is non-taxable, but the interest you are earning is taxable in case of traditional non-deductible IRA. So here, if you see in case of distribution, the accumulated earning, which is your interest or dividend, that is taxable. But what is non-taxable is your principal contribution which you are making. For example, every month you are making a contribution of $500, right? In a year, you are making a contribution of $6,000, right? On that, you are earning, let's assume, interest of $100. That $100 is being considered into the taxable income in future when you withdraw it, not now, right? Any doubt so far? Okay, so minimum distribution are required to be taken by April 1st of the year following the year in which taxpayer reaches the age of 70 and a half years. So the year in which you reach or your client reach 70 and a half years. So you need to make certain minimum withdrawal by the April of the next year. For example, in let's assume in October 2022, your client has reached to the age of 70 and a half years, right? In his case, he need to make certain minimum withdrawal on or before the 15th April 2023, right? By the next year, April, he or she minimum need to withdraw a certain amount from those IRAs, right? So we'll be discussing about certain rule. So just skip this table. We'll be discussing this table tomorrow. So this small part we'll be discussing tomorrow. I still need to do some work on this one. So I'll get back to you on this part tomorrow. But so far, if you have seen, we have covered the traditional IRA, both the parts, which is deductible and the non-deductible, all the features of deductible, all the features of non-deductible, when it is taxable, when it is not taxable, when non-deductible is taxable, when non-deductible is non-taxable, when deductible is taxable, and when non-deductible is not taxable. So we have seen all the possible scenario, right? Now we are jumping on to the third topic, which is called Roth IRA. So Roth IRA is a new age individual retirement account. So this came into effect recently in 2002, right? Before that, the companies or individual were enrolled in the traditional IRA. So Roth IRA, contribution to the Roth IRA is not deductible, like we have discussed earlier, and you can make like contribution of $6,000 if you are age less than 50. If you are age more than 50, you can add additional $1,000. If you are filing jointly, you can take up to $12,000. If one of you is more than 50, then $13,000. If both of you are more than 50, then $14,000 of the contribution. So contribution limit, whether it's being traditional or Roth, is same. However, the accumulated earnings in case of Roth IRA is not taxable in future also. That is the advantage of the Roth IRA. Whereas if you see in the traditional IRA, earnings are always being taxable, whether you choose deductible or you choose non-deductible. But the benefit of the Roth IRA is that earnings are non-taxable. So distribution of both principal and interest are also tax-free if they are qualified distribution. The only thing is it should be a qualified distribution. What is qualified distribution? Right? So that we'll also understand. But before that, let's understand the allowable Roth contribution phase out. So in the Roth IRA, people can do the contribution, but again, there is some limit of phase out. The phase out limit for unmarried is $125,000 to $140,000. For married filing jointly, $198,000 to $208,000. and married filing separately is $0 to $10,000 only. So here the phase out limit are very much different than the traditional traditional deductible IR, right? So if you see, the qualified distribution must meet the following criteria. First one is you need to deposit into the Roth IRA for at least 5 years. So contribution should be at least 5 years, and the person should have aged more than 59.5 years before he or she withdraw, right? So if the withdrawal does not fit into this criteria, then that withdrawal is called non-qualified withdrawal, and that result into taxable income. But if withdrawal is within all these limits, then it is considered as a qualified withdrawal and it is not taxable, and the interest part also not taxable. Make sense? So first one is 5-year contribution. At least you should be making 5-year contribution. Second thing is you or your client must be of the age 59.5 years. Third is to a beneficiary after the taxpayer death. So to the beneficiary after the death of the taxpayer. So for example, if there's a taxpayer who was contributing to the Roth IRA, but unfortunately he or she died before the 5-year contribution or before the age of 59.5 years, right? Then the amount goes to the beneficiary hand, right? In the hand of beneficiary, it is not considered as taxable income. Fourth is because of the taxpayer is disabled. For any reason, if taxpayer is become disabled and he or she need money to take care of himself, in that case of scenario also, the tax law is always generous and it is not taxable. So these are exception of withdrawing the amount before the 5-year or before the 59.5 year of age, right? Fifth point is first time home buyer, maximum 10,000 distribution only once in the lifetime. So if you are purchasing home, so everyone know buying a home is a big deal, right? And United States of America government and IRS, they want people to buy the home, right? Hence the 10,000 up to $10,000, if you are withdrawing from the IRA, even though you have deposited for less than 5 years or your age is less than 59.5 years, that amount is exempt. Then qualified birth or adoption. So if you got a new baby in your family, right, whether it's your own or you're adopting it, right, in that case of scenario also up to $5,000 for individual, or if you're filing jointly, then up to $10,000 is being allowed, right? Last one is COVID related distribution made after January 1st, 2020. So maximum $100,000 for the COVID related distribution. So non-qualified distribution are taxable to the extent of earnings only. So any qualified distribution is okay, but any non-qualified distribution is considered as ordinary income. Got it? Any doubt? Are you guys here?
ये मैरिड फाइलिंग सेपरेटली कितना ये कैसे कैलकुलेट करते हैं 0 to 10,000 वाला का?
Same way, like for example, here it is married filing separately. The maximum contribution is 6,000, right? If his or her income is, let's say, $5,000, and let's assume $8,000, and let's assume $15,000. So in case of $15,000, zero deduction. In case of $8,000, how much will be the deduction? 6,000,
4,500.
8,000, 6,000, 1,200 is the deduction allowed. Same is the case here. Instead of 8,000, it will come 5,000. So 3,000 deduction is allowed. Same formula. Vivek? Make sense? Total maximum deduction allowable $6,000.
We have
Right.
taken income 8,000.
Yeah, 5,000, 8,000, and 15,000.
If more than that, in like
Then more than 10,000, then zero.
okay.
Right?
The-
That's what it means. If you see here,
okay.
it's saying married filing separately, 0 to 10,000 is the phase out limit.
और सारा इन्हीं के ऊपर आके गिरता है.
Yes. So not a good state to live. So it's better to get married and file joint return. Right? So next one is rollover and conversion, but yeah, maybe we can take a break over here. Right? After the break, we start with the rollover and conversion plans. So far, we have covered, if you see, major chunk of it, which is like traditional IRA in both deductible, non-deductible, and we have also covered Roth IRA. Right? Now, after the break, we'll be covering rollover and conversion, and then minimum required distribution. Right? So let's take a break. It's 5:50. We can come back at 6:20.